On this regard, I welcome ECB President Christine Lagarde to this second monetary dialogue in ECON for the 2021. The previous monetary dialogue took place on March 18. Last June 10th, the ECB Governing Council decided to confirm its very accommodative monetary policy stance in order to preserve favorable financing conditions, to reduce uncertainty and bolster confidence, thereby underpinning economic activity and safeguarding medium-term price stability. In the meantime, the ECB is conducting its strategy review aimed at providing ideas about the best tools and objectives to fulfill in the macroeconomic landscape of next years, its mandate of price stability in the medium term as well. We took note of your commitment, Madame Lagarde, in the introductory remarks of the monetary dialogue held on September 28th of last year to interact more closely in the context of the ECB strategy review and to ensure that our regular dialogue plays a key role in how we inform about this exercise. Since the launch of the strategic review on January 23rd in 2020, its conclusion has been postponed to the second half of 2021 due to the pandemic. As this extraordinary exercise will soon come to an end, we have proposed to exceptionally add the strategic review to the two other topics that were selected by ECON coordinators for today's monetary dialogue. So the two specific topics selected by coordinators for discussion at this monetary dialogue are, first of all, the effects of the negative interest rate policy, and the second, the spillovers from US fiscal and monetary policies. All the briefing papers prepared by the panel of experts are available on the ECON website. In line with agreed practices, the following procedure will be applied for this exchange of views. There will be an introductory remarks by President Lagarde of about 15 minutes, followed by 5 minutes question and answer slots with the possibility of a follow-up question, time permitting, within the same slot. So 2 minutes maximum for the question and 3 minutes maximum for the answer. In the first round of questions, each political group will have 1 slot. And thereafter, we will apply the DONT system, which determines the order of questions by political groups. If time so allows, additional slots will be allocated on a catch-the-eye basis, taking due account of the weightings of each of the political groups. And please, really, I ask you all to strictly respect the time given to you. President Christine Lagarde, we are now looking very much forward to hearing you. Welcome again, and you have the floor for 15 minutes.
Thank you so much. And Madam Chair, dear Irene, honourable members of the Economic and Monetary Affairs Committee, ladies and gentlemen, good afternoon, and it's a pleasure to be back with you on this second session, as you have mentioned, Madam Chair. While we are, unfortunately, still meeting on air and not in person, and we are still in this virtual setting, the health situation and the economic prospects across Europe have improved on the back of significant progress in vaccinations, with more than 100 million people in the European Union now fully vaccinated. This makes me hopeful that we will meet again soon in person, in Brussels, and face-to-face. Let's hope. In my remarks today, I will first discuss the economic outlook for the euro area before turning to the ECB monetary policy, including the recent decisions that were taken by the Governing Council. And as per your explicit request, I will also update you on our ongoing strategy review, as you have mentioned it. Let me first of all look at the current macroeconomic and inflation outlook for the euro area. The outlook for our economy is indeed brightening as the pandemic situation improves, as the vaccination campaigns progress, and as confidence begins to rise again. We expect economic activity to accelerate as of this quarter amid support from fiscal and monetary stimulus and a vigorous bounce back of services activity in particular, which had been hardest hit by the pandemic and associated containment measures. Manufacturing production remains robust, although supply shortages, mainly related to difficulties in procuring materials and equipment, could generate some headwinds for industrial activity in the near term. Soft data also signals strong momentum in global activity, led by the rebound in advanced economies, where vaccination rates have picked up. Additional fiscal support, most notably the US fiscal stimulus package, is also supporting the recovery. These developments boost foreign demand and so have positive spillover effects on the euro area. Looking ahead, we expect economic activity to improve strongly in the second half of 2021, supported by a robust rebound in consumer spending and solid business investment. Our latest staff projections currently foresee annual real GDP growth at 4.6% in 21, 4.7% in 22, and 2.1% in 23. The risks surrounding the growth outlook have become broadly balanced. While on the downside, the spread of virus mutations continues to be a source of risk, on the upside, brighter prospects for global demand and a faster than anticipated increase in consumer spending could result in an even stronger recovery. Turning now to price developments. Euro area annual inflation has picked up over recent months, largely owing to temporary factors, including strong increases in energy price inflation. Headline inflation is likely to increase further towards the autumn, reflecting mainly the reversal of the temporary VAT reduction in Germany, before then declining at the start of next year. I'm talking here about the inflation rate, not about VAT in Germany. So declining at the start of next year as temporary factors will fade out. Underlying price pressures are expected to increase somewhat this year, owing to temporary supply constraints and the recovery in domestic demand, but they are likely to remain subdued. As you specifically asked me to comment on the spillovers to the euro area from rising inflation in the United States, let me point out that these occur both through the direct channel of imported goods originating in the United States and through several indirect trade or expectation mechanisms. For example, to the extent that the increase in inflation reflects a stronger demand in the United States, inflationary pressures for the euro area can materialize owing to higher foreign demand for euro area goods and services. International spillovers from US inflation can be amplified if people in the euro area shape their inflation expectations also on the basis of developments in the United States. Overall, however, the effects on euro area HICP inflation are expected to be moderate. Once the impact of the pandemic recedes, the unwinding of the high level of slack, supported by accommodative fiscal and monetary policies, will contribute to a gradual increase in underlying inflation over the medium term. However, the upward effect of the underlying inflation pressures on headline inflation will be roughly counterbalanced by the expected decline in energy prices. Accordingly, our latest Eurosystem staff macroeconomic projections foresee headline inflation at 1.9% in 21, 1.5% in 22, and 1.4% in 23. If we compare with the March 2021 ECB staff macroeconomic projections, inflation has been revised up for 21 and for 22, largely owing to temporary factors and higher energy price inflation. And it is unchanged for 23 at a level which unfortunately is below our inflation aim. Let me now turn to the ECB monetary policy stance and the decision that we took a few days ago. At our last monetary policy meeting in early June, we conducted a joint assessment of the developments in financing conditions, taking into account the updated inflation projections. Borrowing conditions for firms and households have remained broadly stable, although market interest rates have increased further since March. While partly reflecting improved economic prospects, a sustained rise in market rates could translate into a tightening of wider financing conditions that are relevant for the entire economy. Such a tightening would be premature and would pose a risk to the ongoing economic recovery and the outlook for inflation. Against this background, at its meeting on June 10th, the Governing Council decided to confirm its very accommodative monetary policy stance. In particular, based on our joint assessment, we expect to continue to conduct net asset purchases under the Pandemic Emergency Purchase Programme over the coming quarter at a significantly higher pace than during the first month of this year. Our comprehensive package of complementary measures has proven effective in preserving favourable financing conditions for all sectors of the economy, which is essential for supporting a sustained economic recovery and safeguarding price stability. Asset purchases under the PEP have helped to stabilise financial markets and ensured a smooth transmission of our monetary policy to the key interest rates that determine the funding costs for businesses and households. Meanwhile, our targeted longer-term refinancing operations, also known as TLTRO, have provided banks with funding on favourable terms, provided that they sustain their lending to customers. The total amount borrowed in Eurosystem refinancing operations stands at around 2.2 trillion euros. Since the outbreak of the pandemic, this has been almost exclusively concentrated in the third series, known as TLTRO 3. In all, TLTRO 3 is expected to contribute to increasing lending volumes by over 4% cumulatively and to lowering lending rates by more than 60 basis points. Without our measures, we would have faced a much worse growth and inflation outlook, subject to significantly greater risks. According to our conservative estimate, the measures taken by the ECB since March 2020 on asset purchases and TLTRO will cumulatively increase inflation by around 1.2 percentage points and real GDP growth by around 1.8 percentage point between 2020 and 2023. The asset purchases and TLTRO also strengthen the effectiveness of other measures in our toolbox, including the negative interest rate policy, which you asked me to discuss today. We have clear evidence that cutting the deposit facility rate below 0% has provided additional economic stimulus as it has fed into lower lending rates, thereby helping to improve overall financing conditions for firms and households. Of course, despite these positive effects, negative interest rates have often been criticised because of their potential adverse side effects. On the whole, however, our assessment of our experience with negative interest rates continues to be positive, as the benefits continue to outweigh the costs. In this regard, our two-tier system for reserve remuneration has been acting as an effective mitigation tool for the banking sector. Banks can deposit part of their excess liquidity at a preferential rate, thereby limiting their direct costs and preserving their role in transmitting the accommodative stance of monetary policy to the economy. Finally, let me turn now to our ongoing strategy review. I have just recently returned, actually last night, from a 2-day Governing Council retreat which was dedicated essentially to that topic. As you know, we've embarked in this journey in January 2020, shortly after I took office. Unfortunately, we had to take a long pause due to COVID, and we only resumed our strategic review activity in April. The process we suspended it in April and we resumed it in the autumn. So, pandemic started in March, we suspended the process in April, and we picked it up again in the autumn. And we have since the autumn progressed vigorously. That review, which is taking place after a long period of no review at all for 17 years, is designed to cover all relevant aspects of our monetary policy in line with our promise not to leave any stone unturned. The Governing Council's deliberations so far have been supported by a tremendous effort by many staff members of the ECB and all the national central banks of the Eurosystem in a genuine European effort. The collaboration has been organised into 13 different work streams, and we also gathered, in addition to their input, essential input for the review by having many outreach events throughout the euro area and collecting views from a wide range of stakeholders. We listened to expert audiences like academics and analysts. We listened to politicians, to civil society organisations and individual citizens. And I greatly appreciate the insightful contributions from the European Parliament throughout the process. We have listened carefully to the concerns you raised during the hearings, during the plenary debates, during ad hoc visits to the ECBs, in our correspondences, and also in your resolution on our annual report. Since all the issues covered in the seminars are highly interdependent, the remaining discussions will focus on deriving their joint implications for our monetary policy strategy. We made good progress during the retreat, and we will make the outcome of the strategy review public after we have taken formal decisions, and we are not yet at that stage. Let me reassure you that this Parliament will continue to play a privileged role in the follow-up phase. This committee, your committee, represents a unique forum for presenting the outcome of the review to all European citizens, and I'm looking forward to the constructive debate that will follow. So to conclude, Madam Chair and honourable members, as the recovery is gathering pace, we need to remain vigilant and ensure that policy support continues to provide a bridge over the pandemic and well into the recovery. The common European approach adopted during this crisis is a great achievement and should be strengthened further. With Europe playing a key role in shaping people's lives, it is important that we take the opportunity to make the most of the attention we receive. As the French Enlightenment thinker Emmanuel Joseph Sieyès once said, "Authority comes from above, trust from below." This holds true to this day, and is why I was pleased to see that the latest Eurobarometer recorded widespread increases in public trust in all European Union institutions. Some 49% of EU citizens now say that they trust the European Union, an increase of 6 percentage points compared with last summer. We should build on this in the recovery phase and ensure that we continue doing all we can to earn the trust of those we serve. Thank you very much for your attention, and I now look forward to your views and also answering your questions. Thank you.